need to understand in business that a small profit is always better than a big loss.
Warren Buffett, the Oracle of Omaha, is a legendary investor known for his simple yet powerful approach to building wealth. His strategies have been studied and emulated by countless investors around the world, making him a beacon of financial wisdom. He believes in buying great companies at fair prices and holding them for the long term. This approach, often referred to as value investing, focuses on identifying undervalued stocks with strong fundamentals and growth potential. Buffett's investment philosophy centers on minimizing risk and maximizing returns over time. He advocates for thorough research and understanding of the businesses you invest in, rather than chasing short-term market trends. His advice has guided generations of investors, proving that you don't need to be a Wall Street whiz to succeed in the market. By focusing on the basics and maintaining discipline, even novice investors can achieve significant financial growth. Buffett's famous quote, "It is important to understand that small profit is better than big loss," perfectly encapsulates his risk-averse approach. This principle encourages investors to prioritize safety and steady gains over risky ventures that could lead to substantial losses. He understands that investing always involves some level of risk, but he emphasizes protecting your capital above all else. By avoiding speculative investments and focusing on well-researched opportunities, Buffett has consistently achieved impressive returns. By focusing on consistent, smaller gains, investors can build a solid foundation for long-term financial success. This method not only reduces the emotional stress associated with market volatility, but also ensures a more stable and predictable growth trajectory for your portfolio. Many new investors fall into the trap of chasing quick riches, seeking the next hot stock that will make them millionaires overnight. This strategy is incredibly risky and often leads to devastating losses. Buffett's approach, however, emphasizes the power of compounding small gains over time. Even modest returns, when reinvested consistently, can snowball into significant wealth over the long term. Think of it like rolling a snowball. It starts small, but as it rolls and accumulates more snow, it grows exponentially larger. The same principle applies to investing. By focusing on consistent, manageable gains, you create a solid foundation for long-term financial growth. One of the most critical aspects of investing is risk management. Before putting your hard-earned money into any investment, it's crucial to understand the potential downsides. How much are you willing to lose? What happens if the investment doesn't perform as expected? Buffett stresses the importance of investing in businesses you understand and avoiding unnecessary risks. Diversifying your portfolio across different asset classes is another key risk management strategy. By spreading your investments, you reduce the impact of any single investment performing poorly. Remember, protecting your capital is paramount. Compounding is often called the eighth wonder of the world, and for good reason. When you reinvest your earnings, those earnings generate their own earnings, creating a powerful snowball effect. Even small amounts, when compounded over time, can lead to remarkable growth. Consider this: if you invest $1,000 today at a 7% annual return, it will double to $2,000 in about 10 years. In another 10 years, it will double again to $4,000, and so on. This exponential growth is the magic of compounding, and it's a key reason why Buffett advocates for a long-term investment horizon. Brick by brick, building wealth over time. Building wealth is like constructing a sturdy building. It requires patience, discipline, and a focus on the long term. Just as you wouldn't expect to build a skyscraper overnight, you shouldn't expect to get rich quickly in the stock market. Instead, focus on making consistent contributions to your investments, even if they seem small. Over time, these contributions will add up, and with the power of compounding, they will grow into a substantial nest egg. Remember, Rome wasn't built in a day, and neither is financial security. The downside of swinging for the fences. While it's tempting to try and hit home runs with every investment, this approach is fraught with risk. Swinging for the fences might lead to occasional big wins, but it also significantly increases the likelihood of striking out. Remember, in investing, it's not about hitting home runs, it's about scoring more runs than you strike out. Focusing on consistent base hits, those small but steady gains, will ultimately lead to greater long-term success than chasing risky home run investments. Icarus and the markets when high flyers fall. History is littered with examples of high-flying companies that crashed and burned, leaving investors with significant losses. Remember the dot-com bubble of the late 1990s? Investors poured money into internet companies with no profits and unsustainable business models, only to see their investments evaporate when the bubble burst. These cautionary tales highlight the dangers of chasing speculative investments. While it's important to be open to new opportunities, it's crucial to approach them with a healthy dose of skepticism and a keen eye on risk management. Learning from the mistakes of others. One of the best ways to avoid costly investment mistakes is to learn from the experiences of others. Study market history, read books by successful investors like Warren Buffett, and understand the factors that contributed to both booms and busts. By understanding the mistakes that others have made, you can avoid repeating them yourself. Remember, knowledge is power, and in the world of investing, it can mean the difference between building wealth and suffering significant losses. Protect your nest egg: practical tips for smart investing. In this section, we will explore some essential strategies to safeguard your investments and ensure long-term growth. So, how can you apply Warren Buffett's wisdom to your own investment journey? Buffett, one of the most successful investors of all time, emphasizes the importance of patience, discipline, and understanding the businesses you invest in. Here are a few practical tips that can help you navigate the complex world of investing and build a robust portfolio. First and foremost, invest for the long term. Just like a plant takes time to grow, your investments need time to mature and yield returns. Avoid the temptation to make quick profits. Don't try to time the market or chase quick profits. Market fluctuations are normal, and reacting impulsively can lead to losses. Stay calm and stick to your strategy. Focus on companies you understand. Invest in businesses whose operations, products, and services you are familiar with. This reduces the risk of unexpected surprises. Stick to businesses whose products or services you know and use. Diversify your portfolio to spread risk. A well-diversified portfolio can weather market volatility better. Don't put all your eggs in one basket. Diversification is key to managing risk. Spread your investments across different sectors and asset classes. Spread your investments across different asset classes. This includes stocks, bonds, real estate, and other investment vehicles. Reinvest your earnings to maximize growth. Let the power of compounding work its magic. Reinvesting your earnings can significantly boost your returns over time. Be patient and disciplined in your approach. Building wealth takes time and effort. It's a marathon, not a sprint. Regularly review your investment strategy and make adjustments as needed, but avoid making hasty decisions. Stick to your plan and don't panic sell when the market fluctuates. Remember, the market will have ups and downs, but a well-thought-out strategy will help you stay on course and achieve your financial goals. Diversification. Don't put all your eggs in one basket. Imagine putting all your money into a single stock, only to see that company go bankrupt. It's a nightmare scenario, but it highlights the importance of diversification. By spreading your investments across different asset classes, industries, and geographies, you reduce the impact of any single investment performing poorly. Think of diversification as a safety net for your portfolio. Just as you wouldn't rely on a single source of income, you shouldn't rely on a single investment for your financial well-being. The long game, patience, and consistency in investing. Investing is a marathon, not a sprint. Just like marathon runners train for months, even years, to build their endurance and strength, investors must also prepare themselves for the long haul. It requires patience, discipline, and a long-term perspective. This means not getting swayed by short-term market fluctuations or the latest investment fads. Instead, focus on the bigger picture and your ultimate financial goals. There will be ups and downs in the market, but by staying focused on your goals and sticking to your investment plan, you can weather the storms and come out ahead in the long run. It's important to remember that market dips are a natural part of the investment journey and can even present opportunities to buy quality assets at a lower price. Remember, Warren Buffett didn't become one of the world's wealthiest men overnight. His success is a testament to the power of patience and consistency. It took decades of disciplined investing, a focus on minimizing risk, and a belief in the power of compounding. Compounding is the process where the returns on your investments generate their own returns, leading to exponential growth over time. By embracing these principles, you too can achieve your financial goals and secure your financial future. Whether you're saving for retirement, a child's education, or a dream home, the key is to start early, stay consistent, and remain patient. Over time, your disciplined approach will pay off, leading to financial security and peace of mind. If you found this video helpful, make sure to subscribe to the Rich Roadmap channel for more insights and tips on achieving financial success. Stay informed, stay invested, and stay patient.